Hey everyone, I'm Professor Stefan. Today we are starting a new topic, property, plant, and equipment, or kind of long-term fixed assets. So let's get started. All right, so let's start with the definition of kind of what PP&E, or property, plant, and equipment, really are. Well, these are kind of long-term fixed assets that are actively used in operations. And they are expected to provide some sort of benefit beyond the current accounting period. So we should get some long-term benefit out of this asset, which is why it goes in that long-term section of our balance sheet instead of a current asset or instead of getting expensed immediately when we buy it. So it's got a long-term benefit for our company, and it is a physical asset. So we're going to deal later on in the semester with our intangible assets, but the assets we're talking about here in these next few classes are tangible. These are things you can touch. And finally, we have different phrasing that we could call these things. Usually in class, I'm going to call it PP&E, but that includes a lot of different things. You could call them plant assets, fixed assets. There's all sorts of different phrases, long-term fixed assets that you could use that kind of captures what we're going to be talking about here. Now, our PP&E has kind of a life cycle where different types of events and different accounting choices we're going to have to make show up at different periods during the asset's life. So when we acquire the asset, which is what we're going to be talking about today, we have the acquisition of it, and we have to determine what costs we're going to capitalize. Things change a little bit if we're building kind of a long-term fixed asset on our own, and we have to deal with kind of interest capitalization. Now, once we have the asset and we're using it, we're going to have to depreciate this thing over its life, so kind of take it into expenses. We may get new information about its expected life, its salvage value, etc., and we're going to have to learn how to deal with that new information. We are going to sometimes repair this equipment or improve this equipment, and so that's going to come with different accounting choices. And then finally, the value of this equipment might change over time. Something that we thought had a lot of value, maybe that could change with a changing market. So we're going to have to deal with changing values of our PP&E as well. Now, when we dispose of these assets, we could sell them to somebody else. We could exchange them for other assets, and these are going to come along with different accounting choices we have to make. So over the next few classes, we're going to deal with this whole life cycle of PP&E. So our first decision we have to make is that when we acquire a fixed asset, what costs actually get capitalized into the fixed asset on our balance sheet. And remember, when I say capitalize, it means we're crediting cash because we're paying for something, and capitalizing it means we debit an asset account, debit our balance sheet, instead of debiting an expense. So capitalizing just means debit PP&E. So what costs actually go into that PP&E value? And so we're going to include the price of obtaining an asset. We're going to include any costs that we have to pay to kind of bring it to where we need that asset. So kind of any shipping, handling, delivery costs, etc. And we're going to include any costs we incurred to kind of get it ready to use. So it's going to include a lot more than just the price, the MSRP of the asset that we're buying. It's going to include everything to get it ready. And the idea behind that is that what we're trying to do here is we're trying to match our expenses to our revenues. And so if this asset is going to generate revenues for us over the next, say, 10 years, we want to take all of the costs of that asset and spread them out over those 10 years as well. So that's why we include things like the kind of shipping and handling charges. We include things like setup or installation costs, because we're trying to allocate those expenses over the period that we're going to get the benefits from the asset. So let's dive a little deeper into kind of what costs specifically might relate to kind of different asset classes. So if we think about, say, land, right? This is a relatively simple asset. So we're going to capitalize the purchase price. We're going to capitalize real estate commissions, right? If we have to pay a realtor to acquire this land, that's going to get capitalized so it can get allocated over time. Attorney's fees, title search fees, title transfer fees, insurance per title insurance premiums, and any costs even to remove old buildings are going to get capitalized into the value of that land. So there's a heck of a lot more than just the purchase price itself. Now, land improvements are slightly different in that these are kind of separately identifiable costs, things like driveways, parking lots, fencings. So not part of a building itself, but sort of land improvements that make it usable for our business, landscaping, roads, etc. All of that will also get capitalized, but that goes into a different account that is eventually going to get depreciated over time. So the land account will not get depreciated, but our land improvements will, because those are going to deteriorate over time. They're going to lose value. They might have to be replaced. So we want to allocate that expense to our revenues. Land, on the other hand, it generally holds its value or goes up. So we're not expecting any depreciation. We don't record any depreciation on the land itself. So let's think about kind of what costs are associated with buying equipment. We, of course, again, have the purchase price that will get capitalized. We have taxes that we pay. So sales taxes will go into the asset value on our balance sheet. That will get capitalized. We could have transportation costs, delivery costs, installation costs, any modifications we have to make to the building to install this equipment could get capitalized so that the expense gets spread out over the period that equipment will generate revenue for us, and costs to kind of test it and get it up and running. So kind of trial runs, make sure everything is working right. All of that will also go into the value of that asset. Now for buildings, things we put on our land, they're going to look kind of like the land account in that we're going to have the purchase price. We could have attorney's fees, real estate commissions again, any costs to kind of recondition or improve that building, and any delinquent taxes. So if there are past taxes due on a building that we have to pay in order to kind of get it, up to speed with the government, those would also get capitalized into the value of that building. So remember the big picture for PP&E. What we do want to capitalize are any costs required to acquire and put an asset into use. So that's why we have that big list of costs, and it's all the stuff that we have to pay up until the asset is ready for production. That's what gets capitalized. Now, there are a handful of costs we don't want to capitalize because it doesn't fit that criteria. So interest incurred on debt to buy some plant assets is not going to get capitalized because the asset is already intended, kind of ready for use, right? If you already have it in production and you're paying interest on debt you acquired to buy that thing, the asset's already operating, does not get capitalized. The interest does not get capitalized. If you have to train employees to use some new piece of equipment, that is not going to get capitalized into the value of the asset because theoretically the value improvement is the skills of the employee. The asset itself doesn't really change. Now, annual insurance costs or property taxes. So these are kind of the ongoing costs of owning the building or owning the piece of equipment. Those will not get capitalized because you incur them every year and the asset again is kind of already operating for you. So those will just get expensed as incurred. And finally, we're going to talk about repairs a little bit more in a later class, but kind of ordinary repairs that just keep a piece of equipment functioning. Those will get expensed as incurred as well. Okay, so we've talked about what costs get capitalized into that asset value on our balance sheet. And now I want to address kind of what happens if you pay one price for multiple assets. And this could occur very commonly if you're buying, say, a building and the piece of land that it sits on, right? You want to depreciate the building, but not the piece of land. So how are we going to kind of divide up this purchase price between these different fixed assets? Now, the nice thing is how we're going to do this is exactly how we've allocated prices before. So if you remember revenue recognition, we would sell a bundle of goods for a single price, and we would have to kind of divide up that price between all of those individual goods. Here we're going to do the same thing, where we're going to allocate the purchase price. Now we're the buyer of a fixed asset. We're going to allocate our purchase price to the different kind of assets that we're buying based on their standalone fair value. Now we can get these fair values from different places. We can do insurance appraisals, property tax assessments, independent appraisals if we want to hire somebody, because some of these can be kind of tricky to determine fair values, but we're just going to do the best job that we can. And you can imagine, managers might have some kind of tricky incentives here. If I'm trying to allocate my purchase price between a building and a piece of land, I know the land will never get depreciated. So if I can allocate more purchase price to the land, that's going to save me expenses and give me higher net income in the long run, which would be, overall a pretty nice thing. So I just bring that up to say, be aware that these sorts of choices, there is usually discretion by management. And it's helpful to know kind of where they might exercise or how they might be incentivized to exercise this discretion. So let's look at an example here of this kind of lump sum purchase thing. Let's say that we have an acquisition price for land, a storage facility, and a piece of machinery, and we're going to buy all of that for $90,000. And so we need to know how much value goes to land, how much goes to the storage facility, and how much goes to the piece of machinery. And so we get these things appraised, and we find out that the land has a fair value of $30,000, the storage facility has a fair value of $50,000, and the machinery has a fair value of $20,000. So what we're going to do is we're going to use these fair values to divide up that $90,000 purchase price. So if we take these appraised values, we can see that individually, these things add up to a total fair value of $100,000. So we essentially got a $10,000 discount or a 10% discount by buying them together as a bundle. And so what we're going to do is we're going to say, okay, well, the land makes up $30,000 of this $100,000 total fair value, or about 30%. So it's going to get 30% of the value of the purchase price, or $27,000. The storage facility is $50,000 out of that 100. And so it makes up about half the value of this purchase price. So it'll get half the value of the $90,000. And the machinery is $20,000 of the $100K total. And so it's going to get 20% of that $90,000 purchase price, or $18,000. So you can see that the cost that we capitalize adds up in total to the actual $90,000 purchase price. So we're not going to capitalize more than what we actually paid for this bundle. It's just taking what we paid and dividing it up proportionally based on the fair values of these assets. So if you wanted to see what the journal entry looked like here, we would debit the land for $27,000, debit the storage facility for $45,000, and debit the machinery for $18,000. And then we have a credit to cash, what we have to pay for this stuff, of the full $90,000. So then the last thing I want to talk about, we kind of talked about the what costs get capitalized on the balance sheet. We talked about what happens if we buy multiple assets for a single price. The last one is, what if we don't pay cash up front? What if instead we pay by kind of issuing a note payable and say, hey, we'll pay you this in the future, we'll pay you some interest in the meantime. What if we issue a note payable instead? Or what if we pay with equity, some shares of securities instead? Kind of how do we figure out what the value of the asset is that we're buying? What gets capitalized on our balance sheet in that case? And so for both kind of debt and equity scenarios, if we know the fair value of the asset we're buying, that's what's going to get capitalized on our balance sheet. Now, if we don't know the fair value, we're going to have to do some different things. If we're kind of issuing a note payable and saying, hey, we'll pay you, we'll pay you X amount 3 years from now, then we're going to have to present value that note payable to kind of estimate the value of the asset we're buying. If we're issuing, or if we're kind of giving away marketable securities instead of cash, we could look at the market value of those securities and say, kind of, is this a reliable estimate of the value of the asset? So between these options, we want to pick the ones that kind of gives us the most reliable estimate of the value of our asset. So let's take a look at a quick example here. Let's say Jafar Enterprises purchases a piece of equipment on January 1st in exchange for a $9,000 non-interest bearing note that is due in 2 years. So they're saying, look, I will pay you $9,000 2 years from now. In between there, I'm not paying you a cent. The prevailing interest rate on similar liabilities is 8%. And at the date of acquisition, what we want to know is what value should the equipment be recorded at on the balance sheet. And the idea here is that even though I'm going to pay $9,000 in cash, because I'm paying it 2 years from now, the value of the equipment is not really worth $9,000. If I were to pay cash today, I could get away with paying less than $9,000 because of kind of the time value of money, right? $9,000 2 years from now is worth less today. So maybe I could get away with paying $7,000 or $7,500 today instead of the $9,000 2 years from now. But it raises the question of, well, what do I debit as the asset value on my balance sheet? So in the first scenario, let's say we knew the fair value of the asset was $7,000 and that was a reliable number. If we know the fair value of the equipment we're acquiring, well, then we can just record its asset value at that $7,000. So I debit my asset for $7,000 and credit a note payable for $7,000. Things are a little more complicated if we don't know the fair value of the asset, right? Then what we have to do is we have to present value this note payable and say, what is this note payable actually worth today? So you can plug this into Excel and we can go over this in class. But let's say the future value of the note, what we're going to pay in 2 years, is $9,000. In between there, I'm going to make 0 payments, so my payment term is 0. My interest rate on similar notes is 8%. And the number of periods I have, assuming we're compounding annually, is 2. So we have 2 years in between now and when I pay the note. If you plug all of that into Excel, or you can do a present value formula if you want, you can see that the present value of the note is $7,716. And so we're saying that, well, if I paid $7,716 in cash today, I could get this piece of equipment, or I could pay $9,000 2 years from now. Those are kind of equivalent scenarios. And so because the note is worth $7,716 today, I'm going to debit my asset for $7,716 today and credit my note payable for that same amount. So, closing thoughts. We talked about kind of what PP&E is. These are, tangible assets that give us benefits over multiple periods. We always record our PP&E at historical cost, or the acquisition cost, and that includes all of the costs to acquire and put that asset into use. That's what you want to be thinking about if we ask whether a cost gets capitalized. Is it to kind of acquire and put it into use or not? Finally, if we purchase it in a lump sum, we have to allocate that purchase price to the assets using kind of their appraised fair values. And if we are not paying for our PP&E in cash, we have to be kind of careful about what is the value of that asset. We might have to take a present value of the note. We might have to take the fair value of the securities that we're giving up, but we're going to have to do a little more thinking about what this asset is really worth. How much are we going to capitalize it at on our balance sheet? Thanks for watching.